Okay, if you've ever been near the startup world, you know the feeling. You've got this amazing idea, maybe some early traction, but you're staring straight into that financial abyss everyone calls the valley of death. That next round of funding, it feels like an impossible climb. But what if the blueprint for funding was just wrong? Today, we're going to break down a really interesting model called the vector paradigm. It's a whole new way of thinking about how startups get the cash they need to survive and thrive. So here's a plan. First, we'll really dig into that valley of death problem. Then we'll look at a new kind of bridge called venture debt and the very different kind of bank behind it. We'll follow a founder's journey, step by step, see the ecosystem that makes it all click, and finally, talk about why this is a much bigger deal than just another funding option. All right, let's kick things off with the problem, the one every single founder has nightmares about. We're talking about that critical funding gap, the infamous valley of death, where so many great ideas just run out of gas and die. So you really have to ask yourself, why is this so broken? Why is it so incredibly hard to get money right when you need it the most? Well, it's because founders are basically stuck between a rock and a hard place, with two really bad choices. Okay, so on one hand, you've got equity funding. This is the classic deal, right? But the catch is you have to give away a huge slice of your company, your precious ownership, when your valuation is at its lowest. That is super expensive down the road. Then on the other hand, you could try to get a loan from a bank. But, traditional banks, they want collateral. They want to see buildings, inventory, stuff you can touch. And most early stage startups, they've got code and ideas, not warehouses. So that door is just slammed shut. But what if there was a third door, a completely different path, a kind of hybrid solution that's designed to be a bridge to get you right over that valley of death? Well, that's the big idea here. It's a model pioneered by a group called Vector Capital, and the solution is called venture debt. Now, venture debt. This isn't just your average loan. The key word, and this is really important, is strategic. Think of it as a short-term tool, a very specific instrument designed to do one thing: give a startup enough runway to hit its next big milestones. This gets them to a point where they can raise a real equity round. But, and this is the kicker, without giving up the farm early on. There's a quote in the material that just nails it. It says, "This is impatient capital designed to unlock patient capital." And that's perfect, right? It's short-term, fast-acting, impatient money that has one job: go out and get the big, long-term, patient investment that's going to fuel the company's future. It's a key that unlocks a much bigger door. Okay, but here's the thing. For a totally new kind of debt like this to work, and to work safely, you can't just plug it into the old traditional banking system. It just wouldn't fit. You need a completely new kind of financial plumbing, a whole new infrastructure. And that's where something called Sigma Bank comes in. This is the engine that makes the whole thing run. It's what's known as a neobank, a modern digital-first bank. But it's built on a principle they call sound money, and the number one rule is huge. It does not lend out its depositors' money. Think about that. Your regular bank, it's all about fractional reserve banking. They take your deposit and lend most of it out. Sigma Bank doesn't do that. It completely removes that layer of speculative risk. The money for these venture debt loans, it comes straight from their partner, Vector Capital. And this is where things get really, really interesting. This model completely flips the whole idea of collateral on its head. Instead of asking for physical stuff, Sigma Bank uses a philosophy called proof as margin. What does that mean? It means they accept a startup's data, their verified metrics, their proven traction, how ready they are to scale, as the actual collateral for the loan. And this just shows you how massive that shift is. We're going from a world where what mattered was real estate, inventory, hard assets, to a new world where your collateral is a structured data room full of verified metrics. Your proof of performance becomes your most valuable asset. It's about funding your trajectory, not your stuff. Okay. That all sounds great in theory, but what does it actually look like for a founder? Let's walk through what happens over a super critical 90-day period and see this whole thing in action. So the journey is broken into 3 key phases. It all kicks off on day 0 with the bridge. That's when the startup gets the venture debt loan. Then comes the big day, day 90, which is called the conversion. And after that, everything is guided by something called a joint operating agreement, or JOA. And that's basically the new playbook for how the founder and the investors are going to work together. Now, the real magic here is a mechanism called the equity conversion privilege, or ECP. Here's how it works. If the startup uses that bridge loan successfully, proves its model, and gets its next big funding round in that 90-day window, Vector Capital then has the right to convert that initial debt into equity, into ownership. And that's the genius of it. Suddenly, everyone is on the same team. The lender wins only if the startup wins. So let's break down exactly what happens on day 90 at the conversion. It's a three-step process. 1. The original loan amount turns into an equity stake in the company. 2. The interest that was earned on that loan also becomes equity, making the stake a little bigger. And 3, and this is a massive vote of confidence, Vector Capital doubles down and matches their first investment with fresh capital. Bam! The startup is now funded and ready to go. And that interest we just talked about is not just some random number. The whole model is designed to target a 15 to 20% risk-adjusted return. That gets rolled right into the final equity stake. It's basically how they put a price on the risk they took with that initial, absolutely critical bridge loan. Okay, so a sophisticated piece of financial engineering like this, it can't just exist on its own, right? It doesn't work in a vacuum. The only reason this whole thing is possible is because it's plugged into a much bigger, deeply integrated ecosystem.
And they call this the I'm in ecosystem. Think of it like an assembly line for successful startups. It starts with a founder institute, which creates the supply of high-quality, vetted founders. Then they go to the funding lab, which puts them through the ringer, verifies all their metrics, and builds that crucial proof-as-margin data room. It's only after all that Vector Capital provides the venture debt, which Sigma Bank then underwrites. You see? Each step systematically de-risks the next one.
So, when you put all these pieces together, what do you get? This isn't just a new financial product. It's a completely different philosophy for investing. It's a genuine, fundamental paradigm shift in how we think about funding new companies.
And this one quote from the material just says it all. We do not bet on pitch decks. We finance verified trajectories. Think about that. This isn't about gambling on a good story or a fancy PowerPoint. It's about putting money into companies that have already proven, with hard data, that they're on a real, measurable, upward path. Which brings us to the big question, doesn't it? Is this the new blueprint? In a world that is just littered with the ghosts of amazing ideas that couldn't execute, is financing proven execution, not just promising ideas, the future of startup success? And maybe the even bigger question is, if this model really takes off, what does that mean for the entire traditional VC world that's still betting on pitch decks?